During periods of war, such as the conflict between Iran and Israel, the financial markets react intensely and often predictably in certain sectors. One of the biggest beneficiaries is the defense sector. Companies like Lockheed Martin, LMT, Raytheon Technologies, RTX, and Northrop Grumman, NOC, historically appreciate when geopolitical tensions rise. This happens because governments tend to increase military spending, sign new arms supply contracts, and strengthen defense strategies, all of which generate higher revenues for these companies. Attentive investors can capitalize on this trend by buying stocks directly or through sector ETFs, such as the ITA, iShares US Aerospace and Defense ETF. Additionally, the energy sector often benefits, especially companies involved in oil and gas, since conflicts in the Middle East typically push crude oil prices higher. With the escalation of the Iran-Israel conflict, the global energy market goes on alert, creating clear profit opportunities for investors. The region is one of the world's most strategic areas for oil production and transportation. Any threat to its stability can disrupt supply and drive oil prices up. Major American oil companies like ExxonMobil, XOM, Chevron, CVX, and ConocoPhillips, COP, tend to gain value during such times, boosted by the expectation of higher profits amid rising oil prices. Investors can also consider ETFs like the XLE, Energy Select Sector SPDR Fund, which bundles several of these companies into one asset. The volatility caused by war can create very profitable buying windows, especially for investors prepared to buy on temporary dips and ride the recoveries driven by speculation and scarcity. In times of war, investors seek safety, and gold regains its role as a protective asset. Geopolitical instability often triggers fear of losses in risky assets like stocks, leading many to shift capital into gold and driving its price up. However, buying physical gold is not necessary to benefit from this. More practical alternatives exist in the U.S. stock market. Investors can profit from rising gold prices by buying shares in miners like Newmont Corporation, NEM, and Barrick Gold, which typically rise alongside the metal's price. Another efficient method is through ETFs, such as the GLD, SPDR, Gold Trust, which tracks gold prices directly, or the GDX, VanEck Gold Miners ETF, which includes multiple mining companies. These assets tend to perform well, not only during wars but also in economic crises, acting as a safe harbor within a portfolio. During conflicts like Iran-Israel, the US dollar often strengthens, as it is globally viewed as a safe haven currency. At first glance, this might seem positive, but it's important to understand the side effects for investors in American export companies. A stronger dollar makes U.S. products more expensive abroad, potentially hurting companies that generate a large portion of revenue internationally. On the other hand, this scenario opens opportunities. Some companies can pass on these costs or have globally optimized supply chains. For example, Apple, AAPL, despite being an exporter, has strong negotiation power and margins to offset currency fluctuations. Others, like Boeing, BA, while exporters, benefit from defense contracts that can neutralize negative effects. The key is selecting companies with a strong competitive moat and international flexibility. Combining currency analysis with sector insights allows building a smart portfolio even in wartime. During periods of tension and uncertainty like a Middle East war, many investors shift to defensive sectors, those with stable demand regardless of the global situation. This is where defensive ETFs become powerful tools to protect portfolios while still capturing some growth. Sectors such as healthcare, consumer staples, and utilities tend to either appreciate or fall less during tough times. Classic examples include XLV, Healthcare Select Sector SPDR Fund, featuring giants like Johnson & Johnson and Pfizer; XLP, Consumer Staples Select Sector SPDR Fund, with companies like Procter & Gamble and Coca-Cola; and XLU, Utilities Select Sector SPDR Fund, representing electricity and water utilities, services that remain essential even in crises. These ETFs are excellent for investors seeking equity exposure with lower risk, balancing defense and return. In wartime, fear spreads across markets and many stocks plunge due to panic rather than fundamentals. This creates opportunities for those who know how to short sell, profiting from stock declines. Short selling involves borrowing shares and selling them, hoping to buy them back cheaper later. Conflict hit companies with fragile positions or heavy global supply chain exposure, such as airlines, cruise lines, or manufacturers dependent on imports, are often the first to fall. Stocks like Carnival, CCL, American Airlines, AAL, or NIO, can become attractive targets, especially if the conflict impacts trade routes or fuel prices. Inverse ETFs like SH, which bets against the S&P 500, or PSQ, against the NASDAQ 100, also offer ways to profit from broad index drops. However, short selling requires agility, good timing, and emotional control. It's a double-edged sword. The technology sector tends to react mixed during conflicts, but in a modern war like Iran-Israel, it can become a goldmine, especially for companies working with AI, satellites, digital defense, and automation. Giants like Microsoft, MSFT, and Google have government contracts and cloud infrastructure critical to military sectors. Palantir, PLTR, known for data analytics solutions applied to national security and counterterrorism, is often highly sought in these scenarios. Conversely, consumer and digital advertising tech companies may suffer if global consumer confidence drops. Investors must separate the noise from real potential. Security and data-focused tech tends to appreciate, while growth-dependent tech reliant on cheap capital may struggle. This sector demands selectivity but can deliver above-average returns amid chaos. In the current Iran-Israel war, one of the most critical battlefields is online. Cybersecurity becomes a top priority for governments, companies, and financial institutions, boosting stocks of specialized firms. Cyber attacks tend to spike during war, from organized groups and states alike. Companies like CrowdStrike, CRWD, Palo Alto Networks, PanW, and Fortinet, FTNT, are best positioned to benefit as their services shift from optional to essential, with government contracts often rising. Investors can also access this sector via ETFs like HACK, ETFMG Prime Cyber, Security ETF, which gathers leading cybersecurity firms. Thus, cybersecurity offers an indirect but potentially rewarding way to invest in wartime, with controlled risk. In times of war and high volatility, investors seek stability, making stocks with consistent dividend payments stand out. Companies like Realty Income, O, Altria, MO, and Main Street Capital, Main, maintain regular dividend payments even in crises, providing steady cash flow regardless of market swings. This passive income helps cushion losses and can serve as a reliable income source during uncertain periods. Moreover, dividend-paying stocks often have stronger fundamentals and lower volatility, acting as safe islands for capital preservation while maintaining U.S. equity exposure during conflicts. Small American companies, or small caps, are usually more volatile and sensitive to geopolitical crises like the Iran-Israel war. Many investors avoid this segment during turbulent times. However, some see opportunity in their volatility, as small caps can recover quickly and appreciate rapidly once markets stabilize. ETFs like IWM, iShares Russell 2000 ETF, provide diversified exposure to these companies with controlled risk. Investing in small caps during war requires careful analysis of growth potential, financial health, and sector, favoring companies with good liquidity and low dependence on unstable global supply chains. During wars, major U.S. indices like the S&P 500 and NASDAQ often show sharp volatility. Historically, these indices drop in the early days of conflict due to fear and uncertainty, but often recover over time, especially if the conflict remains localized and does not spread globally. The S&P 500 tends to be more resilient, as it consists of strong, diversified companies across sectors, while the Nasdaq, more tech-heavy, may fluctuate more. For investors, understanding these dynamics allows better position adjustments. For example, increasing index fund exposure during dips to capture recovery, or using options for protection. Knowing the history and timing of these moves is key to crafting a winning strategy amid chaos. Building an anti-fragile portfolio during war means combining assets that not only withstand the crisis but emerge stronger. This involves diversification across defensive stocks, healthcare, consumer staples, utilities, cyclical sectors benefiting from conflict, defense, energy, protective assets like gold, and a cash reserve to seize opportunities during dips. Balance is essential. Defense and oil stocks tend to rise. Gold shields against economic shocks, and defensive ETFs help mitigate losses in volatile sectors. Adding companies with strong dividend payouts ensures steady income flow. This approach reduces risk and creates consistent return potential despite uncertainty and volatility caused by war. This is a comprehensive and balanced approach to investing during geopolitical crises. I particularly agree with emphasizing diversification and defensive sectors, while also recognizing the unique opportunities in defense, energy, cybersecurity, and select tech companies. War-induced volatility is intimidating but can be navigated successfully with discipline and a well-structured portfolio. The caution